robust economy, and the ability to raise and collect taxes. Political risk refers to the political conditions within a country. Since the political climate is closely tied with the performance of a country's currency, investors need to be aware of global headlines. Monetary policy risk refers to the uncertainty that a foreign central bank will, without warning, alter its foreign exchange regulations. Such action by the central bank can significantly affect currency value. This manner of decision-making is unattractive to investors and therefore disincentivizes investment in such countries. Liquidity risk. Liquidity risk refers to when a company or other financial institution is unable to meet short-term financial demands. Since liquidity is the ease with which an asset can be converted to cash, an institution's liquidity plays a significant role in short horizons. But the inability of a company to meet its short-term demands doesn't mean it has no money left. Firms often allocate a majority of their money into long-term securities that have a higher payout rather than hold cash for investment purposes. The problem with this is that converting hard long-term assets into cash is time-consuming and capital-intensive at the same time. There are two types of liquidity risk: cash flow risk and product risk. Cash flow risk is the extent that future cash flows may fall short of investor expectations. This situation would arise as a response to changes in several market variables. Product risk, also called asset risk, is the default potential of a particular asset in response to market value fluctuations. Both types of liquidity risk are relatively niched, so investors won't typically combat threats against them individually, but rather against liquidity risk. Market risk. Market risk is the potential for the value of an investment to decrease due to changes in market factors that drive prices. These factors impact the overall performance of financial markets and can only be reduced by diversifying with assets that aren't correlated with the market. Market risk is sometimes called systematic risk because it relates to factors that impact the entire market, like a recession. The risk of losses on financial investments is primarily caused by adverse price movements. Market risk contrasts with specific risk, also known as business risk or unsystematic risk, tied directly with a market sector or the performance of a particular asset.